All right. On today's episode, we are going to discuss, is this really the golden age of investing and why? Welcome to the ultimate crowdsourced personal finance show. This is Choosify. All right, guys, really excited to dive into this week's episode. So in a recent conversation that we did with Frank Vasquez from Risk Parity Radio, it was episode 313. So you can go to choosify.com/313. We opened it up as an Ask Me Anything with Frank, and we were taking a bunch of questions on diversification versus maybe this more accurate concept of correlation. The idea of the episode being, are you as diversified as you think you are? What's the goal? But in that episode, Frank pointed out that we are living in the golden age of investing. And Brad and I wanted to really flesh that out. What does it mean? Do we appreciate how good we have it? So to help me with this, I have my co-host Brad here with me today. How you doing, buddy?
Hey, Jonathan, I am doing quite well. Yeah, that was a really, really great episode with Frank. I thoroughly enjoyed the Facebook Live aspect of it, which was kind of cool to get questions. And yeah, we definitely need to do that again. I know we kind of teased that at the end there, but there's just so much more. I mean, I could sit personally with Frank and just ask him questions about my own portfolio and what it should look like, how it should change. I think we all kind of intuitively know that ideally we would like to have assets that are uncorrelated, that so that if there's some catastrophe, hey, maybe you have some option of potentially not getting catastrophically destroyed, right? Like I think that's in theory. Like, how can we smooth this out? How can we make the highest likelihood of long-term success and maybe reduce that volatility? Obviously, you can reduce volatility by putting all your money in a mattress, right? But in an ideal world, you are maximizing return while reducing volatility. So yeah, it's interesting, the kind of the intersection of all these things that Frank talked about. But yeah, and Jonathan, it was funny. I got an email today. So as a response to my weekly email that I send out every Tuesday, I basically asked for people to respond. What's going on in your world? What action have you taken? And if you're not on the email list, you can get on by choosify.com/subscribe. But yeah, Spencer wrote me back today, and you're going to love this. He said, Brad, y'all's episode last week with Frank Vasquez was the best one I've ever heard. I've already listened to. How awesome is that?
Frank,
I've
I love
already
you,
listened to
brother.
it.
And I love the episode. It was the best episode that we've ever done.
Yeah. Yeah, Spencer really loved that. He said he listened to it 4
Oh
times
my
already.
goodness.
Just fantastic work. Keep it up.
Wow. Well, we've peaked, guys. I'm going on break. Um,
We can just do best of from here on out. Just put
I love it. All the preparations gone in episodes, and you do, and ask me anything, a Facebook Live, and that's the one. But you know what? I think it actually does point to a larger kind of question and a framework for the types of episodes. This platform exists to hopefully make it easier to find the answers to the questions that you haven't been able to find a satisfactory answer to up to this point. It goes to the crowdsourcing component. And hopefully our audience appreciates at this point in time that you drive the show, right? I mean, we're really trying to act as facilitators to foster the types of conversations that you've been looking for. So, Spencer, thank you so much for that feedback. The golden age of investing. I think, as we're talking about investing, it's probably worth it to just take just a step back and actually identify, what is the goal? What are we trying to accomplish? What is investing? So I guess, I'll send that to you first, Brad. When we say I'm an investor or I want to invest, what is the objective?
That is a very broad question there, Jonathan. I guess ultimately the objective is to accumulate wealth, right? I mean, that's how I would answer that question. I mean, for me, I'm investing because I do not want my money to sit there inert, potentially losing value to inflation every single year and just sitting there doing nothing. I ultimately want my money to earn money, to
Mhm.
earn income, to grow, to compound, no matter what word you want to use behind it. But in essence, I have a significant savings rate, right? I'm a member of the FI community. I prioritize savings. So that's the hard part, right? Now you have this savings. What do you do with it, right? I think I misspoke before and said you could put it in a mattress. I think the saying is put it under the mattress,
No, the
but you
devious
could.
ones, they know it's really like when your room is getting rated, the first thing they do is pull the mattress up. So if you just went with the old default under the mattress, you're already toast. In the mattress is is another layer of complexity. So I heard you and was like, "Yep, yep, the man's thinking ahead."
Sew it into the mattress. So yeah, you can leave it lying around. You could put it in a checking account, right? And it grows it essentially zero. I don't know of any checking accounts these days that give you any type of interest, or you can invest in some manner. And Jonathan, investing is a very broad term, right?
It absolutely is. So if we start with your original definition, which is I want to get to the place where money that I have previously saved or am saving is working for me. It's working to get me to my goals. It's actually becoming a producer as opposed to a token of how much time I have put into this endeavor. Now my money is actually producing additional income for me. It takes people generally a long time to appreciate how powerful that is. If more people appreciated how powerful that is, it would not be near as difficult to get people to save anything or to like to realize like, wow, I should do this, I should do more of this. Financial independence kind of gives us a way of framing the outcome of all of that, the outcome, which is we do enough investing and we do it in the right way that we can predictably get to a point where it's just our money working for. Like realistically, it's not an accident that we get to the place where working is optional. It's a fundamental mathematical truth based on the fact that we've gotten to the point where our money is earning enough money for us to provide for us for, the next year, the next years, the rest of our life. When we're satisfied with that equation, then we're financially independent. So, Brad, we talked about the golden age of investing, and we could make this a history lesson. We could go back to maybe the first stock certificate. We could go back and we could look at the progression of how individuals came up with, corporations and allowed them to sell shares and what it meant to buy share. We could go and take a look at the 1929 crash and the formation of Wall Street, the way that we fundamentally understand it. We could look at chaos theory and a random walk down Wall Street. I mean, we could do a whole history lesson. Or we could kind of just selfishly just focus on what does it mean for us to live in the golden age of investing and recognize that just in our own investing lifetime, just in the last 20 to 30 years, that statement is true. Forget 100 years ago. Forget how investing happened throughout all of human history. Just in the last 10, 20, 30 years, the game has gotten fundamentally so much easier that we could spend weeks and months just here. I mean, it's really I guess where we should start is like you're probably a high schooler. You're finding out what investing means for you in a certain time slot, time in human history. What do you remember then compared to what do we have now?
Yeah. So, it's funny. I don't consider myself that old in the cosmic scheme of things, but certainly 20-year adult lifetime, and a whole lot's changed, right? I mean, a whole lot has changed since I graduated college in 2001, basically, to now, 2021. Not least of which technology, right? I mean, I've I've mentioned this in the past before here in the podcast. Like my very first investing experience it was a negative one because it kind of, I guess, typifies all that was wrong with the old style system. So I had saved up enough money to open a Roth IRA, and I went down to my, Globo Bank that was in the basement of, or the first floor of my office building, and I basically look like chum in the water. Here was this poor kid, wasn't terribly sophisticated, and the person who helped me basically put me in an extraordinarily expensive mutual fund with like this ridiculous front load of like 5% fee just straight off the top, which is basically just commission to him at that point. And I remember it being something that I needed a helper. And Jonathan, that I use that term. That's kind of like a Jack Bogle / Warren Buffett term. Like I needed at that point, you couldn't really do it yourself, right? You needed that that expert, that man or woman expert to help you, right? And what what do they get for helping you? They get this absurd fee. And, it was back in the day when, and again, this sounds ridiculous, but, you showed up with a check, and I want to invest this money. Here's my tangible check. I know, Jonathan, I asked you to write a check one time and it took you maybe a week to find a checkbook. So, you know, it's kind of hilarious how times have changed that, again, I think that story just tells like, man, there's so much built into just that one little experience with the showing up in person, having to get expert, quote unquote, expert help, getting saddled with some ridiculous fee, old style. I have to show up with this money. I can't just send it over. I can't link my bank account. There was no Plaid or whatever it is that automatically safely links your bank account like today. So, just in that one story, there's a lot there.
If you were to go back, 40 or 50 years for absolute certain, at some point in the relative recent history in the scheme of things, you would actually have physical stock certificates to represent, what you own in terms of shares in a company.
Did you have any stock certificates when you were a kid?
No, no, that would
No.
imply that my parents were aggressively saving. Uh,
Okay, fair, touche. That's
we weren't one of those families.
Well, yeah, I certainly do not come from a wealthy family, but again, this goes back to my aunt Karen, who I've mentioned a bunch of times here in the podcast. She was an admin for a stockbroker. That was her entire career, and she passed along a lot of lessons to me, just kind of in passing. It was never like overt, but she bought us individual stocks, like just
Mm,
a couple, So I had this stock certificate, Jonathan, of like one share of Disney, one share of Marvel. It was like all these things that I loved as a kid. And it was pretty cool to
that
see
is
like
actually
there used to be like old style, like, actually art like on the Marvel certificate and the Disney. It was actually really cool. So I
that is really
physically
cool.
had those certificates.
Whoa, I love that. I think actually what you pointed out though, we're going to talk about kind of recent advancements and why we should, be very excited about what it looks like to invest now. But actually, investment options. What are I want to invest, great, but what are my investment options? And Brad, earlier in the call, you actually mentioned probably what most of us think about, like no, not the mattress, though, privacy, security, memory foam. But no, when you think about your investment options, most of us think about saving money inside of a savings account or a certificate of deposit at your bank account. And so the bank account will hold your money, even if you're chumming the water and only have, 20, $30, they'll hold your money, like a la Mary Poppins. And potentially, if you set it up in a certificate of deposit, you might have actually gotten a certificate at one point. But what largely happens here is your money is in the account, and they give you is in the savings account or in the certificate of deposit, and they give you a pre-agreed upon interest rate, which they will pay you some amount. It might vary. Right now, it's virtually nothing, but they will give you some interest rate to hold the money. And why would they do that? It's because they have the capacity based on the arrangement to loan out the money that you have deposited with them at a higher interest rate. And so they make money on the difference, on the arbitrage between the two. And so they highly, all banks highly encourage you to store your money with them. And they give you we are FDIC insured. So your money is guaranteed. And in exchange for you depositing your money with them, they can go out and make maybe more aggressive loans, like doing home mortgages or personal loans or other items, and they will charge a higher interest rate, and they keep that. So that is one form of an investment. Based on current interest rates, it would take you a lot of money or a very very long time to be able to turn that into any sort of meaningful, return on your investment. But that is one form of investing, and it is one instrument that you have. And then as you were working up, like what if we wanted to get a little bit more aggressive? This is where, Brad, to your point, when you owned a stock, you owned a share, a piece of this company's ownership, a very, very tiny piece. But what that means is that when a company is profitable, then more people want those shares, those ownership shares, and the value of your stock actually goes up along with that. And then on the other end of that, some companies will try to raise capital by selling debt. So it's slightly different here, but this is called a bond. A company will try to borrow a bunch of money, and then promise to pay back that money with interest. And so, that is what you're talking about when you buy a company's bond, or even if you were to buy a government bond, you're buying a company's debt and you're going to get the privilege of them paying it back. So these are just a couple, you got your savings accounts, you got your stocks, and you got your bonds. These are all financial instruments that all technically fall under the parent category of investments. But the reason I wanted to go to all that is actually to focus more, in this case, on the stocks. Although really, this could apply to bonds as well. I wanted to actually talk about a couple of the advancements that happened in this space over the last 100 years, but we'll niche down really quick. The first one is actually because like one company can be kind of risky, right? One company can be kind of risky. We don't know what's going to happen with Marvel. They're going to probably keep making more superhero movies, right? But Marvel in the 1990s, Brad, I mean, Marvel was dicey. It was a dicey proposition. I think they were actually going through bankruptcy at one point in the
Yeah,
90s and
yeah.
early 2000s. So you could be really excited about your Spider-Man comics, and then you could have that stock share, and then you could be like, "Oh, I wonder if they're going to survive. Do people still read comic books? I'm not sure." Even now, I'm not sure. That doesn't keep them from making movies, but I'm not sure who's buying these comic books at this point. Anyways, that was a sidebar. Brad, I thought we could spend just a little bit of, you could maybe kind of overview, the mutual funds and what a mutual fund actually is, because historically, and this is just a fun fact you'll appreciate, the first mutual fund was actually started in the 1920s, at least the modern day mutual fund that we think of today, and it was actually Vanguard. It was their Wellington Fund, was started in 1924. And that is massive, even for us today, to appreciate that. And I'd love for you to kind of give people a little bit of a sense of what a mutual fund is and why that massively changed the game for, modern day investing.
Yeah, that's fascinating. I actually honestly did not know that the Wellington Fund started that early. I think when I looked this up, I looked up Jack Bogle and when did he create the first Vanguard S&P 500 index fund? And it looks like I'm actually at our friend JD Roth's site, Get Rich Slowly, and he said on December 31st, 1975, paperwork was filed with the SEC to create the Vanguard First Index Investment Trust. And I guess that launched in August of 76. So, I mean, in the grand scheme of things, that's a pretty recent occurrence in the investing world because, frankly, like even when we were growing up, the late 80s, 90s, even 2000, early 2000s, like mutual funds were not as prevalent as they are today. They weren't as nothing was as user friendly. And I think that's what we're trying to say here in general, just with this episode, is like never before has it been as easy to do it yourself, right? And going back to your actual question, Jonathan. So mutual fund in this regard, I think this kind of touches on what you said in passing there about stock ownership, which is you own a tiny little piece. When you own a stock, right? You own a tiny little piece of that company. And how tiny that is depends on how many shares of stock each individual company has outstanding. So, there might be a company like Apple, for instance, and this is off the top of my head, let's say they have a billion shares, right? If you own literally one share, you own 1 billionth of Apple. That's a very, very tiny little amount, but still it's not nothing, right? And the point again of investing over a lifetime is to get a little bit more of companies, or in the case of mutual funds, many, many companies, all in one fell swoop. And this is the genius here, which is you look at the S&P 500, okay? So the Standard and Poor's 500 index, right? These are in theory, though it's not quite precisely, but in theory, these are 500 or the 500 biggest companies that trade in the United States. It's plus or minus. There are some specific requirements to get in the S&P 500, so it's not quite literally the 500 biggest, but it's pretty darn close to that. So basically, it's a cap weighted fund. So, and Jonathan, I know you've talked about your own kind of maybe issues, in investing with a cap weighted fund, which is the biggest companies in one of these funds, they are going to be weighted much more heavily. So when you own an S&P 500 index fund, and let's say you have $1,000 in there, it's not like that $1,000 is split across those 500 companies equally, right? In that case, you'd have $2 in each company. It doesn't work that way because it's cap weighted. So the biggest companies, right? The Apples, the Amazons, the Berkshire Hathaways, you're going to own a disproportionate percentage of those. But that said, you still have a small portion allocated to companies 300 through 500, right? You own a tiny, tiny little piece. And I think the concept is, again, to own something that the creator of this fund believes approximates the market in the closest sense. So you don't have to stock pick. I think that's where so many of us get it wrong, both on the information side and on the behavioral side, right? The psychological side, which is, hey, we think we can time the market. We think we have some special knowledge that's going to allow us to pick the right stocks. And I think the sad truth is we don't. Most of us don't. And most of us don't and can't do it on a regular basis over the course of a 30 to 60 year investing lifetime. So I think that's where the beauty of an index fund comes in. And so Jonathan, it gives you a broad array of companies to invest in, but it's also self-cleansing. And I know that's something that you love to focus on.
Yeah, as you were kind of rolling these out, I wanted to, because we actually have three different kind of enclosures as we're talking about stocks to kind of work through the differences on, and I think all that there is kind of a framework for thinking through how can I optimize my return and minimize my risk. So when we started with this idea of this individual stock certificate for Marvel in the 1990s was pretty dicey. You may not have had a lot of money, you had a single share, single stock, but let's say all of your money was tied up in Marvel in the 1990s and Marvel is going through bankruptcy or Marvel is getting restructured or whatever. There's a very real chance that if a company that you have all of your money tied up in because you believe in that company, but then the thesis doesn't map out, something goes wrong and they go into bankruptcy, your shares become effectively worthless and all your money disappears. So your risk, when you have a lot of it tied up in a single company, it's maybe higher than you would like, even if you actually do believe in what the company is doing. So how do you mitigate that risk and still get some of the return? Well, you might diversify. So maybe you have 5 or 6 companies that you get very excited about, right? But even then, you're still, going back to Frank's episode, that's, you're not very diversified. That's not very diversified. So the mutual fund in 1924 was the first one where, like, instead of you, and remember how hard it used to be to get an individual stock or to purchase these individual companies, a mutual fund was potentially a way that you could, by buying this one fund, you could get a bundle of maybe 50 companies, 100 companies, 500, 1,000. It was a way that you could bundle them all together. And then you would have a team of people that would be managing when to add companies to it and when to take companies out. And this was like, this is the easiest way that you could get diversification and convenience all in one very tidy package was through a mutual fund. And then Brad, you mentioned 1975. That was the year of Bogle's Folly. That's what they called it, Bogle's Folly. This crazy person, Jack Bogle, says, we don't actually even need to bring on this world-class team that picks the winners and the losers. We're going to just have all the winners and all the losers all combined together, and we're going to track, this index of, all right, we want to have this much of this fund, this much of that fund based on some sort of predetermined algorithm. And we'll just have a computer that just maintains that. It'll just be a computer code. And we're not going to try to pick winners and losers. We're going to maintain a cap weighted percentage, basically. I mean, it's predetermined, but we're going to follow this rule based structure and just do this. And guess what? What the prediction was that just by not having to pay this team a lot of money and being able to reduce the overhead of this team, we are going to, that is a guaranteed locked in return that you don't have to worry about. And that was the bet. But the entire investing industry laughed at Jack Bogle. Like, of course, you want to not own the losers. You want to only, like, that's what they're there for, is to not own losers and hold the winners. But basically now, 1975 to now, we have like 25 plus years of data to say that Bogle's Folly, which is what they were calling it at the time, dominates dominates the process of, actively picking funds over any, even intermediate really time period, but certainly over a 30 or 40 or 50-year timeline. And this is what JL Collins points to in his Simple Path to Wealth. And so that is like three different approaches, and they all kind of layer on top of each other. You have a single stock, which is just I'm going to own a single company. I have this mutual fund idea, which is I'm going to own a bunch of different companies by having this one container, and it'll be managed by a team of people that'll pick when to get in, when to get out. They'll handle all of that, but they're expensive. They have some costs next to it. And then you have Bogle's Folly, right? We'll have index fund investing piloted in 1975 to say, we're not even going to worry about winners versus losers. We're just going to we're going to focus on keeping the fees rock bottom low, and we're just going to maintain the allocation of time. And this will ensure that you keep up with the market. Because if you just look at what the market's done over any 30, 40-year period, it's absolutely insane. So like if we can just keep up with that, we're going to do better than once you keep in mind what these actively managed mutual funds, once you keep in mind what they're doing, they cannot beat the market once you account for their fees over long periods. Brad, I just wanted to I think it's really important for people to see that progression, because now we have the choice. Like in 1950, you didn't have the choice of all three of these. You could do individual companies or you could go do mutual funds. Index funds weren't an option. But now in 2020, 2021, you can do, I mean, we're barely scratching the surface on the number of ways that you can invest. But what's happened is, even in the index field arena, which has clearly won when it comes to just performance over this period of time, even in the index fund space, we have seen a continual race to the bottom on fees as they've gotten better at this, as they've been able to streamline the process that supports it. The actual expense ratio that you would pay even for an index fund has been cut by a factor of 10 and beyond. It's insane how it's dropped over the last 20 years.
Yeah, no, you're absolutely right. And I think this is something we've touched on so many times here on Choosify, the impact of fees on your investments and just how critically important it is to lower fees if at all possible. So that's investment advisor fees, assets under management, which are really destructive, even though it's only 1%, right? You hear 1%, you might hear 1% on your mutual fund. Oh, the expense ratio, it's just 1%. But as we've shown over and over again, this can ultimately lead you to a 30 to 50% lower net worth after a 30 to 50-year investing lifetime. So, needless to say, and Jonathan, we won't do the math again here, but needless to say, that is a massive impact. So, to your point, we've seen the expense ratios. That's the general fee we talk about when we talk about mutual funds. We've seen them drop dramatically to the point where, a fan favorite of the FI community, VTSAX, which is the Vanguard Total Stock Market Index Fund, I think it's 4 basis points at this point, which is 0.04%. And I know Fidelity actually came out with some 0%. Fidelity Zero funds. So, there has been quite literally a race to the absolute bottom here. So, you are going to pay a tiny percentage of fees, if at all, to get a broad market, total stock market index fund, S&P 500, things like that. So, just from we talk about the golden age of investing. I mean, that is case in point number one of to me why this is the golden age. That this has become something that, like you said, index fund investing has won to a large degree. The inflows of money into those funds have been dramatic, and because of competition, right? That's capitalism, right? There's competition, and these funds have realized, okay, I can do this for next to nothing, or maybe in the case of Fidelity, nothing, and maybe, who knows, this is a loss leader, to get you as a client, right? Like, I mean, this truly is something that's virtually free, and that is a remarkable thing. And I mean, that is a massive difference from, again, just standard mutual fund fees. Like, we used to consider it standard that you would pay 0.75% up to 1.5% mutual fund fees, and that's not to mention my chum in the water, front load, pay us 5% just for the sheer right to invest your money with us. We'll let you invest with us for 5%. So Yeah, I mean, it really is remarkable.
So, we're going to go back to some of the investment options that are out there, but those are so big, and it's definitely the 80/20 of what we're talking about here. But the other thing to recognize in terms of the golden age of investing is actually that the changes that have been made to the tax code to give us the ability to control our tax rate have never been more favorable than they are right now. And this wasn't always the case. And some of this is good and some of it's bad, but let's take a slight walk back and take a look at maybe the 1950s and 60s. Your retirement was tied up in a pension typically. A corporate your employer would have a pension, and that's a good thing in that retirement was kind of taken care of as long as you put the time in. You would have something for you on the other side. Grumpus has talked about this a whole lot, and we'll have an episode with him coming up in the somewhat near future here. I believe it's actually coming up this Monday, talking about a different case study with regards to pensions because they're still out there. But let's talk about like the downside of pensions. What you were actually invested in was entirely dependent on your employer, and if your employer went bankrupt, your pension disappeared right along with that. Your ability to control the return on your investment, the type of investment, you were entirely dependent on the employer. The control was entirely in their court. Whereas now it's a little bit more of the wild, wild west and has been. But over the last, I know we're going to look at some of the dates here, Brad, because I wrote a couple of them down. The first one, 1974, the traditional IRA came available. In 1978, the 401k became available. In 1997, the Roth IRA, I didn't realize it was that recent. The Roth
Wow.
IRA became available. And then in 2003, the HSA, and in 2010, the 457B.
Hmm.
Like these are all relatively recent advancements in, the investing history, in the golden age of investing. And these massively, massively affect our ability to control our tax rate and to save for this financial independence that we're pursuing.
Wow, that's incredible to see that on paper. Right. 457, 2010, HSA 2003, Roth IRA. That's a shocking one to me that that's
Yeah.
as recent as 1997. So, yeah, I mean, these different buckets, right? That's what, we kind of loosely refer to them. Like you have these different investing options. And yeah, to your point, controlling your tax rate is one of the real secrets of the FI community. I think because we are such prodigious savers, we're able to maximize many of these, right? Many of these accounts. And what most of them do, so basically every single one that we listed there except for the Roth IRA. So that's after tax money that you're contributing, but all the other accounts that we mentioned are pre-tax. So that means every dollar that you put into those accounts in that tax year, you get as a tax deduction. So that comes straight off the top of your taxable income on your return. So therefore, because we have a taxation system that has marginal brackets, right? That top dollar, that last dollar, the marginal dollar is the highest percentage that you pay. So this in essence, you're getting the benefit at your highest marginal rate. So I mean that is a massive difference. And we always talk about here in the FI community about controlling what you can control. And I think this to me is one of the beauties of this entire message is that you have autonomy. You have control over your life as opposed to some elusive they. And the two aspects that I look at it the most with finances are with the two things we just talked about. The fees, right? You can control fees and you can control your taxes to a large degree, which is interesting, right? Because if you ask 100 people off the street, hey, do you have any control over your taxes? Most people are going to say no. That's some politician, that's some blah, 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 whatever it is, right? Whereas there are people in our community, the millionaire educator is a perfect example, right? He maxes out his 403b and his 457. And for him and his wife, they can put away, I think, well, actually, they have additional benefits because they're slightly older, but let's just say they can max out 19,500 each times four, right? You're at $78,000 just there. On two teachers' salaries, you take $78,000 off the top and then take away your standard deduction and you take away any child tax credits, you're paying essentially, if not, I mean, I would almost be willing to guarantee $0 in federal tax. And you've now stocked away all this money, right? And because you've controlled your tax rate at that point. I mean, how cool is that? And then, Jonathan, obviously, this is outside the bounds of this, but
We never let it stop us before.
yeah. No, I was going to say, like, the Roth IRA conversion ladder. And, we have episodes about that and segments about that, certainly. But like, you can even control, especially if you're following a FI lifestyle and you're keeping your life kind of lean and mean on the expenses side, you might even be able to pay $0 in taxes when you're pulling this out, or pretty darn close. So, like, isn't that the most beautiful thing, right? You're controlling your tax rate on the way in. You're putting this money away in these amazing investing options, these different buckets, and then you're pulling the money out tax or nearly tax free. I mean, that's the holy grail.
Yeah, I wonder if people like did a little head shake if they really latched onto it when you said they were investing, 19,500 times four. Like if they really and they were like, wait, how are you doing four different accounts? And we talk about it in depth with Millionaire Educator a couple times that we've had him come on, but most prominently in episode 13, choosefy.com/013. But I just wanted to hit that because we mentioned it in passing here, that 457B and the 401k. There are some public school districts and or public you got to it's probably going to be some sort of public, I'm sorry. Yeah, some sort of public company or entity. So it might be a hospital, it might be a police department, fire department. Not everyone, but a lot of them will have access to a 401k and a 457B. A lot of public service will have access to these. They on the front end they look very similar. You can contribute up to the 19,500 in each of them pre-tax. They have some unique characteristics on the backside which make them look very appealing. But Millionaire Educator, in his case, him and his wife both had access to the 401k and both had access to the 457. And so they were basically between that and the traditional IRA and the HS, they were basically throwing their entire salaries, both of them, into these accounts pre-tax. And I believe what they were living off of, he does actually break that down, but I think he created what kind of is like an annuity. It's called a SEP 72T. It's the, yeah, substantially equal periodic payments. And so you basically turn one of your retirement accounts into kind of an annuity, and it allows you to access that money ahead of turning 59 and a half. And he walks through that. It's very niche, but because he put that money in pre-tax and he's drawing it out in a scenario, he's controlling his tax rate. It's a thing of beauty. And so that's how you can kind of, taking advantage of all your money's fungible. It's in various buckets, understanding how the tax code works. He's able to save kind of the money he has the least control over for later when he has more control over the tax rate, and draw down money that he's already accounted for using a technique like this. But I mean, there's a lot of these kind of weird, interesting caveats that it's not going to really serve you until you've started saving money. But you should never be afraid of saving money because you don't know what the tax rate is going to be later. Like that's a problem to get to when you get a little bit closer and you're now looking, how do I draw down in the most, cost effective way? Brad, when we actually get into some of the actual features, things that we can do now, we talked about kind of these instruments and mutual funds and index funds, but even when you go a little bit more granular and you're looking at just things that you can do now, how easy it actually is to get your money into those accounts beyond the tax vehicles and beyond the instruments that we're using, just the tools that we have to choose from are incredible.
Yeah, it really is. I mean, it could not be easier to do this on your own. And, that's not to say it isn't daunting the first time that you sit down and you go to open up an investment account. I'm not trying to minimize that by any means, but in terms of actual ease, I mean, goodness, you could do this all on your own within 15 or 20 minutes, right? You can open up an account, you can at any major broker, right? I mean, we talk about here, we talk about Vanguard, we talk about Schwab, Fidelity, M1 Finance, I know is your favorite. And I mean, you can open an account, you can set it up, you can link your bank account, right? I mean, think about all of these things that would have been impossible to imagine 30 years ago, right? Linking your bank account. You can
Right. I mean, just
deposit.
so people don't gloss over that, it probably in the past it was like filling out a form and
Yeah.
sending it in along with the deposit check or something along those lines. And then you get an
Yeah.
email back, or you get a not an email, you get some sort of message back telling you that they needed some sort of additional piece of verification before they could actually make your first deposit. Like it was a long, arduous, drawn out process.
Yeah, like mail in a voided check, as ridiculous and antiquated as that sounds, right? And then, right, having to go into the brick and mortar location and like fill out forms and say, hey, this is what I want to put in. And I mean, now you can do that all automatically. You can set up, and you cannot overlook this. You can automate your investing. You can say, hey, I want to put in this number of dollars every X period, right? That might be $100 every week. It might be $1,000 every other week. Whatever it is, like that's the beautiful thing is you control that, right? It depends on what works for your life. Maybe depending on when you get paid or when all your bills come out. It might shake out that hey, I want to determine when how much money I'm putting in the 20th of the month. Like you could do it personally. I'm kind of saying bold things here. Like you can send money yourself. You can just log in real quick and say, hey, I've got this extra money lying around. I want to just send this over. Or you can set up the automated payments. You could do some combination of both. Sometimes you save a little bit extra, right? And you want to zip it over there. All right, you log in. It takes, I mean, Jonathan, what does it take? 2 or 3 minutes at most to log in and send some money, purchase. You can buy any fund. I know I haven't paid even at Vanguard or Schwab. I have not paid a commission in as long as I can remember, even on non-Vanguard and Schwab funds. So, there's some even you used to get dinged like that, right? It was 7.95 or back in the old days, 15, $20, whatever it was for any kind of trading fee, right? You talk about all these expenses that used to exist and they aren't there anymore.
Mm.
So it's pretty awesome that you can do this on your own. You have so many options. You have these low cost options. You can connect it automatically. You have thousands of different options to invest in, right? Individual stocks, ETFs, mutual funds, whatever it is. And you can do this as it fits your life. And I think it's really, really cool. And we shouldn't, that's why we're doing this episode. We shouldn't gloss over it. And I know there's even next levels to it, right? Like we talk about, robo advisors is kind of like a pejorative, I feel like, but there's a lot of really good things to some of these new kind of financial, what fintech do they call it, right? So I know that's near and dear to your heart.
Anyone that says robo-advisors is a pejorative, that's very ageist, man, because my generation, we love that stuff. No, I mean, I want it to be done automatically. I want it to be, goes back to automated investing. There was something else that you mentioned in there, which is like, yeah, we don't have trading fees, but we also don't have to have money on the sidelines anymore. So between the lower entry points, just even when we started back in 2017, didn't Vanguard, just even as recently as 2017 for their VTSAX fund, they had like a $10,000 entry limit to start using that fund. And then while we were doing this podcast, they lowered it down to 3,000, but also the awareness of the ETF. And so like, even for the privilege of being in our fund, you need to bring us at least $3,000 and then you can be in that fund. But then you get access to dollar cost averaging, and we'll explain that term in just a minute. But I just want to point out you can start with $10. You can start with $20 now. You do not need, even when you understand what an ETF is. So we talked about mutual funds. And mutual funds have some unique characteristics over ETFs, but it's just worth pointing out since so many people are aware and like and look for, the VTSAX that JL Collins talks about in his book, The Simple Path to Wealth. And we talk about on this show all this time that there's an ETF version of that fund called VTI. They're the same. One is a mutual fund, one is an ETF. They have the exact same allocation of companies in there. And the reason I bring that up is that a lot of the robo advisors will not have access to like a mutual fund that is an index fund like VTSAX, but they will have access to all the ETF versions. So VTI. Now, I realize I'm getting in the weeds here. I just for the purposes of moving us forward and kind of talking about just some of your advantages, I want us to now think about something like VTI. So when we're using one of the various robo advisors that are out there, and we've actually interviewed the founder of M1 Finance, Brian Barnes. So that one's probably very familiar to our audience at this point, but that is not the only one. There are several out there. We could talk about Wealthfront. We could talk about Betterment as two kind of prime examples. M1 Finance is another one. They all have some various strengths and ways that they kind of target the services that they're offering. But the key here is you can set up an account in less than 15 minutes, to Brad's point. You can have it linked to your bank account in less than 5 minutes. You can have your first deposit in and you can be off to the races. This would probably have been many years ago, it would have been a multi-week process of you following up and making sure that everything is done. So no friction, you can just get going. And then they have no limits in terms of like you need to bring some certain amount. You need to bring $10,000 in order to invest in the fund. You need to bring no, you 25 bucks, 25 bucks, 20 bucks, you get started with that. And then you can create rules, say, oh, I get paid every 2 weeks. I get paid $800 every 2 weeks. I'd like to set aside $50 every 2 weeks to go into, my investments. Oh, well, it's unfortunate, actually, this fund, the share is actually $60. So if you're only doing 50 every 2 weeks, well, then you're going to need to wait, until you have, do you follow me on this? That would have been the old way. The old way would have said, if you want to buy a share of something and it's $60, you need to wait until you have $60. And so if you're only doing 50 every 2 weeks, then you have to wait another 2 weeks to be able to afford to buy the share. And then you're going to have 40 bucks left over. Does that make sense? That would have been the old way. That would have been par for the course. That's what everybody expected. It was reasonable. It's time to be unreasonable. And when you're in the golden age of investing, you can be unreasonable and get what you want. And what I want is when I have $50, I want to invest $50. I want a fraction of a share. I want 90% of a share. I want to get my money working for me. And that's what these robo advisors do. And so with something like M1 Finance, you only have 50 bucks, then buy 90% of a share of VTI. That's totally fine. And then when you have another 50 bucks, we will top that one off and we'll get you the next one as well. This is what you should expect. You should be unreasonable. You should be unreasonable when it comes to fees. They should be racing for the bottom for your business. You should be unreasonable when it comes to features. They should make simplicity of the utmost priority. It should reduce friction. And there's so many more. I mean, we're honestly, even though we're in the golden age of investing, Brad, I think we're just starting to scratch the surface between the money that you earn and getting your money working for you and thinking about ahead of time, what are the rules that I want to put in place that will dictate the outcome that I want to get to? What if you can just front load a little bit of that work and then your actual finances from there on out are basically on autopilot?
Yeah, that is really interesting, and I suspect that a lot of these companies, the M1 Finances, the Wealth Fronts of the world, are looking into creating this if they haven't already, right? It's almost like a if this then that, right? You have everything connected. I mean, this is something when I talk about my personal finances are on autopilot and I spend ten minutes a month. I've said that a number of times. Uh, I think that's directionally accurate. We'll say it's pretty darn close, but it's because I've set everything up to happen automatically and I'm not the constraint in the system. So what that means is in my case, and this is suboptimal, which is where a lot of this stuff will be optimal, which is I leave some extra money lying around in my checking account, so I never have to worry, do I have enough money, right? Do I have enough money to pay that credit card bill that might be a little larger? Do I have enough money to pay whatever might be coming out of there, whatever I have that month. So again, I do it in that suboptimal way, but wouldn't it be cool if your entire financial life was automated? So this one central repository knew exactly what your credit card bill was going to be, exactly what your utility bills were going to be. Every time you wrote a check, which you probably wouldn't do, you could do it through them, right? And it all happens automatically and electronically. So it knows, and then it can therefore move money around for you, which is kind of cool, right? Like I don't need to leave an extra $5,000 lying around to basically make up for my own idiocy, more or less, right? Or my laziness is really probably the better way to put it. But if this all just happened in the background and it optimized, right? Then that means every extra dollar, you would know how many extra dollars you have and you could just sweep it into investments and get that money working for you. So, yeah, I mean, to me, that's where I see the future of this. There's no world where, we talk about fees, Jonathan. Think about how many tens, if not hundreds of millions of dollars worth of fees, probably more. I'm probably being naive. People pay in overdraft fees, right? Or other ridiculous bank fees that, they just didn't realize. They're paying this absurd fee to the bank because the bank let them take an extra $20 out of their ATM when they didn't have the money, right? Well, what if you had a holistic system that just kind of moved that all around for you, and then you're not paying these ridiculous fees? So, yeah, I mean, to me, that's super exciting, and is certainly, if it doesn't exist now, which I strongly suspect it does, is going to exist in the next couple of years.
Yeah, and where, is as fascinating and awesome as it is for accumulation, when you start talking about drawdown, right? Like what does your bucket strategy look like? This is something very complex, but really it's just executing a game plan. A very, it's a rule-based game plan. If you understand that it's a rule-based game plan, you front load that work, you put those rules in place, and then the ridiculousness of a millionaire or potentially a multimillionaire ever having an overdraft fee because they didn't transfer the money out of one bucket into the next bucket is laughable, right? So if you can just do a rules-based strategy to make sure that never happens, you're going to be covered. It's all your money. Your money is fungible. Some of it's in investments, some of it's in a savings account, some of it's in your checking account for easy access. It's all your money. This all kind of goes to the point of making everything very fluid, very seamless, thinking about things through the lens of dollar cost averaging. And dollar cost averaging is actually kind of magical. There was an article on Motley Fool that I stumbled on a long time ago, and it kind of broke it down, and it's a little nuanced. So I hope you guys can follow me. I will have it all linked up in the show notes, this article as well. But let's just map this out. Let's say that we want to invest $10,000 in a particular stock. And so let's say that you chose to invest $2,000 on the first trading day of the month for 5 months, and you're trying to build this position. We're using dollar cost averaging. So, January 1st, we invest $2,000, February 1st, March 1st, April 1st, May 1st, $2,000 on each one of those days. Now, the price per share fluctuates pretty wildly on each of those months. So on month one, the price per share was $50. On month two, it was $40. On month three, it was $20. On month four, it was $40. And in month five or May, it was $50. But we were going to, fractional shares, but we were going to invest $2,000 regardless. So what that meant is on the months where the price went down, we were actually to increase the number of shares that we purchased. So in January, we got 40 shares, February, 50 shares, March, 100 shares because the price tanked. Then the following month, we got 50 shares. And then in May, we got 40 shares. So, that's just kind of laying out this table. Again, have this article linked up in the show notes. But the actual implications for us was that we invested $10,000 using dollar cost averaging over this 5 month period of time, and we were able to purchase 280 shares. Now, the key to this whole thing is that if you were just to take the average of $50, $40, $20, $40, and $50, which are the five different prices that we pay, the average of that would be $40. But that's not actually what we paid with dollar cost averaging. Because remember, we were actually able to get more shares for our money when the price went down. Our average price per share was only $35.71. So this is a mathematically favorable price. And what it means, it's very nuanced, but if your big takeaway on this, go check the article to check the math. Dollar cost averaging is a way that would guarantees a mathematically favorable average price for your investment. This is a huge concept to keep in mind, and it really points to the strength of just buying what you can afford over the long term. As you're able to afford, just buy. And don't get worried about whether the price is going up or down. Just know that what allowed us to really lock in that advantage is when it went down, our money that we were planning on investing went further.
Yeah, Jonathan, that's interesting. I've never heard about that or thought about that before. I'll be interested to read that Motley Fool article as well. But I think for most of us, dollar cost averaging is the real, the benefit. And I mean, that's remarkable. Like I said, I need to check that out. But just the simple and most obvious benefit is behavioral again, right? This is, you don't have to think about when to dump your money in. You don't have to worry, am I doing this at the wrong time? Is the stock market going to tank? It's just, this is something you do. And in most cases, you're automating it, right? I mean, you think about your 401k contributions, that's probably the most obvious example of dollar cost averaging, right? Whatever that time period, however often you get paid, you are putting in that same amount, let's say 2 paychecks a month for that entire year, right? You're not dumping all of it in at once and then worrying, is this the best time to do it, the worst time to do it? No, you're buying that amount of money every 2 weeks. And like you said, if the stock market's up, then in that case, you're getting fewer shares. If the stock market's down, you're getting more shares, but you're not thinking about it. And really, our brains are what screw us up with investing more than anything. So, as often as possible that you can take your brain out of it, really the better, frankly. So, to me, that's why I personally love dollar cost averaging, that it's something that goes on in the background. It's not something I need to think about. And, this over weeks and months and years and decades is leading me towards that ultimate goal of investing that we set out at the outset, right? It's to gain wealth. It's to have your money making money for you, right? So yeah, that's why I think this is a really really important strategy.
So, there's only a couple other things that I think we should include in this episode as we kind of start to look at wrapping the golden age of investing. But coming back to what can you actually invest in? We talked about savings accounts, talked about bonds, we talked about stocks. But the way that we talked about stocks, and it's really this is not 100% accurate. We really looked at it more through the lens of owning shares in a company, which can be true, but a company can mean many different things. And so it's important to realize you can buy companies, you can buy portions of companies, but you can also expand out of that. And you can have a lot of these that are wrapped around things like real estate. So if you think about REITs, Frank mentioned this on the episode that we did with him, episode 313. You could have real estate investment trust, which is basically a mutual fund full of different types of real estates. You can buy ETFs, which are stocks in various types of commodity. You can purchase water, lumber, food. Uh, you can purchase stocks that represent precious metals, or you can just purchase precious metals and hold them physically. And people do that for various reasons. But you should kind of think through, what is my goal? Why do I want to do it? Some people purchase these various things because they believe they're going to go up more than various companies. Some people do it because they're looking for diversification. They're trying to hedge against a series or sequence of events. So their goal is not necessarily just pure return, but rather, diversification or correlation, lack thereof. So if one goes down, will something else go in the positive way? So there might be some nuance to, what does it mean to invest? Well, it's investing for maybe a scenario that hasn't happened. But if it does happen, then you want to make sure that you're covered. And some people do this with insurance products as well. And insurance is a very complicated and sometimes expensive topic, but some people invest in and this is the word that I really don't like, and it kind of, I can feel the hackles on my arm, but I know some people view insurance as an investment. I think that's a separate episode, and I would push back pretty strongly on that. But having said that, some people consider insurance an investment. A couple other categories here. You could invest like in a physical business. We've seen examples of that. Or you could invest, Brad, as a limited partner, or just be an investor. I was thinking of Green Swan, I know, did this, and then Leaf,
Yeah.
Physician on Fire, literally just invested in a brewery. Now he did it right before
Nice.
COVID, so I wonder how that one has panned out. But certainly, the logic makes sense, and you see this with angel investors, and venture capitalists all the time, where you invest in a business. There's probably a few more categories here, and we could certainly talk about, the crypto market. We could talk about collectibles, which also have various forms of crypto in there now, as we start to see NFTs, art. But I think we do need to, as we start looking at more and more of these options, we probably need to put a little bit of a partition in between the idea of investing and speculation. And speculation certainly is investing, but I think it carries some nuance that people should just be very mindful of as they're looking at some of these additional options.
Yeah, I think people certainly conflate investing and speculation pretty often. You don't normally hear people saying I'm speculating. You hear, oh, I'm investing, regardless of whether maybe at its actual core it is speculation. And frankly, and this is not me, throwing stones. I mean, I have said dozens of times here on the podcast that my biggest financial mistake was precisely that, was speculating in real estate when, 15 years ago in my mid 20s, when I was just an idiot and I didn't know any better. And basically, at that point, pretty much any asset that you're buying, not for fundamentals, not for income, right? An income flow or cash flow, but just you're buying it and you're basically hoping some other sucker will buy it from you for more than you paid at, X number of months or years in the future, usually months, right? You normally hear, oh, look, this thing went up 100% in 3 months and I'm going to sell it, right? Like, yeah, that's usually not based on fundamentals of what is the company or what is the underlying asset. That's pretty much going to be the definition of speculation. And like I said, I fell prey to that. I mean, I think a lot of us do. But I know I changed my own look at real estate investing just from Jonathan, just from stuff we learned on this podcast. For me, it turned into, which is, it's kind of ironic that I'm a CPA and you would think that I would be versed in this stuff, that, there needs to be some fundamentals. There needs to be a business. It needs to be cash flow positive. There needs to be X% return, right? Like all of these things should be pretty obvious. But I think for some reason with certain items like real estate, first and foremost, a lot of us think about, oh, what is that price going to go up to? You do hear that a lot in these, crypto markets. You hear that with a lot of commodities. Like, is there any fundamental underlying gold? Probably not. Certainly if you listen to Warren Buffett, but does that stop people from investing / speculating in it? No, it certainly doesn't. And I mean, there's a lot of asset classes like that. But, again, that's not to denigrate this. I mean, there are people who legitimately think that many of these things are legitimate investments, and, to each his own, obviously. But I know for me personally, I now look at things in terms of, is there a there? Is there an income? Is there some business? Is there some fundamental behind this?
As we start talking about, I guess crypto in particular, I know people have come at it from different places, and I know that what is speculation to one person is a pure raw investment to someone else. And people's mentalities for getting into things are vary pretty wildly. I think there is kind of like there's a spectrum and there's a nuance to both of them. And I think you really pointed it out when you were talking about what's the underlying fundamental of the reason that you are investing in this to begin with. I'll give you an example from personal experience, kind of in the crypto space, which highlight how both. So I last fall bought $200 worth of Doge to the moon. And I just sold it for about $5,000
Okay.
yesterday. Did pretty good. It actually made me angry how much it went up. In terms of like, are
20,
you kidding?
25 times up.
It was entirely speculative. And it was like a 12,000% or something insane like that, 12,000% return. It was 100% speculation. I had written it off when I purchased it, and it was 100% speculation. But you don't realize it till you sell. So I realized it. It's a real gain. In my mind, it was speculation. I think it's a meme coin. Elon Musk says it's a joke coin. I don't know what's going on. Maybe it's on Robinhood. It makes no sense to me. It keeps up going up more each day. But it was some ridiculous return, and my $100 or $200 turned into $5,000, something like that. Now, I've been just like you. I've been kind of exploring the crypto space, and I remain incredibly skeptical of Bitcoin for kind of the similar reasons. As I feel like we keep waiting for it to go up, so someone else is going to buy it for more, and I don't put that much. And someone's going to give me a lot of grief about this. I'm not really going in particular, but I don't see the fundamentals there. I don't see the utility, but I do. I have had people make the utility case to me about various cryptos, and we could get into some specific examples, but I'm not really even claiming the mantle of authority in the crypto space. I've looked at projects like XRP and XDC, and I've tried to dabble around with a little bit of those. But the reason I bring that up specifically, just to use these as an example, you some of these coins people are saying they are the future because they are solving a very specific problem. We mentioned Swift in the past being kind of like a banking to banking protocol that's actually being used. And I saw a very plausible case that a coin like XRP could have a utility that is, that allows banks going from country to country to make transfers in a much faster way. And if that were the case, it would be worth more based on those fundamentals because, if it's worth more, that would then allow the banks to transfer money more efficiently. Where if it's only worth a little bit, then they would have to transfer more of them to achieve the same goal. So this is one example of many. There are many out there. But I think if you are looking at something like the crypto space, and you are looking at it through a utility lens and it makes sense, that is no longer speculation. It is much like you're thinking you're making a thesis around a company and a stock. Now, your thesis might be wrong and your money might go to zero. And you need to be aware that it may be on the speculation spectrum, But it does not mean that you're hoping that a sucker is going to come behind you and necessarily pay more for it, which I do think is the case with some of the with kind of the mentality. It's like a broken mentality, but it's not necessarily the coin or the technology's fault for that. It's more people get in, they buy $200 worth of Doge, it's worth 5,000. Now they're telling their friends about it. Their friends are going out and buying $5,000 worth of Doge at this higher price, waiting for it to go to 50 or 60x, and then someone's going to lose their shirt. Someone is absolutely going to get burned. And so there are so many different options in investing. I think what we try to do and have done generally is what gives me the best chance at being able to get to the point where working is optional. I don't want to be all in on one hand. I don't want to be in a situation where years of work disappear because I bought, after all the enthusiasm at the tail end of the enthusiasm and I got left holding the bag. That's a very scary place to be. And so, you just kind of have to look at what is your risk tolerance? What is your timeline and what are your goals? And so I think that's why generally we try to keep it as simple as possible. It doesn't mean that you don't explore with different avenues and check out different things, but you definitely don't want to catch yourself in a position where years of work is just wiped out because you thought you were investing, but you were really just speculating. You're really just speculating. And so then that also goes to how do we go about investing generally, regardless of platform, what's your goal? When you're speculating, um, typically what you're trying to do is get out before the next sucker gets in, right? You know that you got it at the right price and they're about to pay too much. So you want to sell it to that person. So that's kind of day trading. And sometimes the market is not rational. The market is willing to pay too much for something. So and to that degree, I get it. Like if you own something and it just 10x'd in price, you're like, this doesn't even make sense. I don't know why they're wanting to pay 10 times more for it than I bought. It doesn't make any sense. Like maybe I want to sell a little bit of that and move it to something that is more that at least I understand that. But generally, because that information is maybe people know more than you know in terms of what something is actually worth. And really it's just going straight up from here. Generally, if we own entire large swaths of the market, it makes sense for us to spend less time and energy trying to figure out how something is valued and when to get in and when to get out, and more just buy them all and hold them for the long term. And that's buy and hold investing. And it's much simpler. It takes up a lot less of your energy. You don't need to worry about whether or not you have the winners and the losers. Go back to just the simple path to wealth and the self-cleansing mechanism of low-cost, broad-based index funds. And so if we look at kind of the four different approaches that we have buy and hold investing, which is just buy and hold for the long term, buy when it goes high, buy when it goes low, take advantage of the dollar cost averaging that we just talked about. We have day trading, which is kind of a bob and weave, get in and get out. And then you can add on multiple layers of complexity to this, and you can invest on leverage, so margin. And then you can take a look at options or futures, which there's some variance in both of these. They get increasingly complex, but it basically gives you the right to buy or to sell the asset at a predetermined price and over a specific time frame. It gets increasingly complicated and for potentially diminishing returns. And so if that is you and that engages your personality, then do your research and proceed with caution. But for those of us that like to keep things simple, we understand that we are already living in the golden age of investing. Things have never been easier. We focus on controlling what we can control, and we build systems to get us to our goal that are not related to you picking Doge on the right day last fall and selling before everybody realized that this is a joke coin that everybody's paying a crazy amount of money for. That's not, you can't build a system around that. And somebody's going to get burned almost by definition. But we can all win with this approach generally, and I hope kind of this helped put some of these ideas into a framework for you. Brad, I just want to give it back to you just for some general final thoughts. Golden age of investing.
Yeah, I mean, I think you summarized it really well there. This is, it's never been easier, and we've never had more realistic options, right? And I think for most of us, for the vast majority of us listening here, the majority of our net worth is going to be in broad-based low-cost index funds. But of course, it comes down to personal preference, and then you can go from there. And that's what's exciting, right? Like there are so many options. And I mean, Jonathan, you even talked, we'll probably at some point have to do a cryptocurrency episode or another refresher on that. But utility, like that's kind of a cool way of looking at it, right? Instead of speculation, which, you give that, and I'm glad you gave that example of that, ridiculous Dogecoin that you played around with. Like you obviously knew that wasn't, there's no underlying fundamentals to that, but even just as an experiment for $200, right? Like even just learning, right? Hey, how do I purchase cryptocurrency, right? How do I open an account? How do I transfer money? Like there was a real high likelihood that blockchain technology, that the fundamental underlying technology here, the utility, is going to change the world, right? There's a high degree of likelihood. So maybe making a making some type of transaction on the Ethereum blockchain and having that 42 character address that you are sending money to, right? Maybe doing that in a controlled environment where it's 50, 100, $200 and going through that and learning. So maybe if you do want to make a legitimate investment after you've done research, et cetera, that you're more comfortable with it. Like to me, that's an experiment worth undertaking. You got lucky turning $200 into 5,000, and that's not replicable, obviously. But just the sheer experiment of learning how to do that is wonderful. I think for many people listening to this episode who are just getting started on their path to FI, literally going to Vanguard or going to M1 Finance and opening that account for the first time, linking their bank account and sending money over and investing in a low cost, broad based index fund. That's that scary moment that you or I might, in our portion of our financial lives, like we might have that scary moment trying out something on the blockchain for the first time. But damn, I still remember that first time that I invested money, and it's scary. That first time you linked it up. And we all are at the point in our investing lives where we are. And you need to get started and you need to experiment, you need to learn, right? Like that's part of the FI journey is we are always learning. We're keeping open minds. And at the heart of it, at the heart of everything we talked about today is we're living below our means, we're saving money, and we're investing that gap, right? That difference between our income and our expenses. And, we are saving this money and we're investing it for the long term. And I think as long as we keep that as our North Star, we're all going to be pretty darn successful. So yeah, Jonathan, I'd say this is the golden age of investing for sure.
All right, my friends, the fire is spreading. We'll see you next time as we continue to go down the road less traveled.